When red numbers started flashing across the screens of Detroit's skyscrapers, Chicago's commodity floors, and Wall Street terminals all at once, no one immediately understood what had gone wrong. But within hours it became evident. The true explosion had originated from the corroded seams of Trump's tariff wall made of steel and aluminum. So how did billion-dollar black holes suddenly appear in the balance sheets of General Motors and Ford? What caused the supply chain to wobble? In this video, we'll break down how GM and Ford took a direct hit from the new tariffs, and what steps they might take to navigate the fallout. Before we dive in, don't forget to subscribe, hit the notification bell, and give this video a thumbs up to stay updated with our content. As a rare summer chill swept through Detroit in late July, alarms were going off on the finance floor of GM's Rensen skyscraper. On that day, word broke that Trump's new steel and aluminum tariffs had slashed $1.1 billion off GM's fourth-quarter operating profit. Now let's drill into GM's numbers. That $1.1 billion in lost quarterly profit erased nearly 3% from its $37.1 billion revenue pie. The biggest culprit? Well, it was higher raw material premiums. Steel prices jumped $220 per ton. Aluminum extrusions climbed $180. Copper strip prices saw a regional 10% dip, a rare relief. Next were the logistics penalties. To dodge tariffs, some parts were rerouted through Canada and Mexico, tacking on $137 million in extra transportation costs. Then came the dealer stock premiums. Anticipating the EU tax hike, European dealers fast-tracked deliveries with a get-it-shipped-now surcharge, costing GM another $113 million in financing. Added up, and GM's $1.1 billion loss wiped over 200 basis points from its net income, post-interest, tax, and depreciation. Ford's troubles took a different form. For its electric lineup, including the F-150 Lightning and Mustang Mach-E, Ford had to swallow an added $118 in duties per vehicle, just for battery cells. Those lithium-ion cells, imported through Houston from Nicaragua, got hit with a 10% component tax. Ford originally wanted to produce the cells entirely in Tennessee, but delays in the supply chain left it semi-dependent on imports. The CFO explained that the Lightning project is extremely sensitive to even cent-level swings in component prices. The tariff bump and cell cost increase added $14 per unit, he said. That's why Ford's looking to shift production. But again, carbon border taxes in Europe are holding those plans hostage. Zooming out, the irony is, well, hard to miss. The Trump administration's wall was built to boost domestic manufacturing. But when that wall triggers tariffs, carbon penalties, and logistics reroutes, American automakers lose margins and start looking for exits. Even if the tariffs disappear tomorrow, overseas production could still be more appealing thanks to lower emissions penalties abroad. So while the scenery may change, the script stays the same. Profits are trending downward. A key question surfaced at GM's latest investor Q&A. Couldn't these tariffs push the company to invest more aggressively in automation and boost long-term efficiency? CEO Mary Barra gave a careful answer. In short, no, not right now. The margin squeeze has extended the payback time on robotics investments, delaying those plans. Cash shortages are putting even long-term cost-saving initiatives on ice. Ford is in the same bind. They had mapped out advanced automation upgrades to reduce fixed costs, but rising steel and aluminum prices have drained the necessary capital. That project, too, is now paused. In other words, the tariffs meant to bring back jobs are now stalling the very automation needed to stay competitive. A vicious loop. In the short term, layoffs loom. In the long run, stalled automation could erode Detroit's global market share. The Trump administration's counteroffer? Still under debate. One proposal under review includes a subsidy package for Boeing, GM, and Ford, featuring credits for high-strength steel purchases, tax incentives in Michigan and Ohio, and logistical support for Latin American sourcing. But the Pentagon's raising concerns. Defense needs a stable, round-the-clock metal supply chain for Patriot and HIMARS systems. If domestic steel producers falter, even battery assembly timelines for defense purposes could slip. Meanwhile, Energy lobbyists warn that if Saudi Arabia shifts more capacity to Asia, the Brent WTI price spread will widen, creating new pressure on the United States economy. So the months ahead will test Detroit's endurance. Margins are narrowing, CFOs are sweating through union negotiations, and GM and Ford must either overhaul their investment geography or achieve one of the sharpest cost-cutting miracles in automotive history. If not, Trump's tariff wall won't just be a campaign slogan, it'll be a rusting spike hammered into Detroit's balance sheets. What's your take on all this? Let us know in the comments, and don't forget to subscribe and turn on notifications to stay updated. Thanks for watching.